Why one rental property changes your financial future. Most Americans think wealth comes from income. Work harder, earn more, save the difference. That is the traditional formula everyone repeats. But something strange happens when people study millionaires. A huge number did not follow that path. They bought property. Not 10 properties. Not a giant portfolio. Just one rental property at the beginning. And somehow that single decision changed everything. The strange part is this. It does not look dramatic at first. The property just sits there. Tenants come and go quietly. Rent arrives every month. Nothing about it feels explosive. But behind the scenes something powerful is happening. A financial engine has started running. And most people never notice it. Because they only see rent. They assume rent is the profit. That assumption misses the real story completely. The truth is more interesting. Rent is only one piece of the machine. In reality, a rental property runs four wealth engines simultaneously. Cash flow, property appreciation, loan amortization, tax advantages. Four forces moving together quietly. And once they start compounding, the numbers become surprising. Imagine a simple example. An investor buys a small rental house for $300,000. They make a down payment of $60,000. The bank provides the remaining $240,000. At this moment, the investor controls a $300,000 asset. But only $60,000 came from personal savings. That is the first shift many people miss. Leverage changes the scale of investing. Now the property is rented. Each month the tenant pays $1,800 in rent. Most people think that $1,800 is the entire benefit. But the interesting part happens inside the mortgage payment. Part of that payment reduces the loan balance. Quietly, every month the debt becomes smaller. The tenant is paying the mortgage. The loan slowly disappears. That process is called amortization. It looks low in the beginning. But over time the balance keeps shrinking. Now something else happens simultaneously. Property values tend to rise over long periods. Not every year. Not every market cycle. But across decades, housing demand grows. Population grows. Construction costs rise. Land remains limited. Now imagine the property value increases 3% per year. $300,000 grows to about $400,000 after 10 years. Notice something interesting here. The investor did not pay that increase. The market created it. Now combine both effects together. The loan balance has decreased. The property value has increased. The gap between them grows. That gap is equity. And this is where the real wealth engine appears. Because equity expands faster than most people expect. Here's a simple illustration. 10 years pass. The property value rises from $300,000 to $400,000. Meanwhile, the mortgage balance falls from $240,000 to about $200,000. Now the investor owns $200,000 of equity. Remember, the original investment was $60,000. This is the moment many investors suddenly understand the system. Their net worth expanded dramatically. Not because they worked more hours, but because the asset kept running. And we still have not discussed the third engine properly. Cash flow. If the rent exceeds expenses, the property produces monthly income. Even a modest surplus matters. Imagine $200 per month of positive cash flow. That equals $2,400 per year. 10 years creates $24,000. Again, this money did not come from a paycheck. The property generated it. Now the fourth engine appears quietly. Tax advantages. Real estate allows depreciation deductions. These deductions often reduce taxable income. Sometimes investors pay very little tax on rental income. That changes the effective return dramatically. Now pause for a moment. One property. 4 wealth engines. Income. Debt reduction. Appreciation. Tax efficiency. Most investments only provide one or two. Real estate combines all four. This combination creates something powerful. A compounding system. And once the first property works successfully, another inside appears. Scaling becomes possible. Because equity can be reused. Imagine the property value rises again. Every finance becomes possible. The investor extracts some equity without selling. That equity becomes the down payment for another property. Now 2 properties are running, each with 4 wealth engines. The system starts accelerating. And this explains something surprising about wealth. It often begins quietly. No dramatic moment. Just a system running in the background. A tenant paying rent. a mortgage shrinking slowly, a property value rising gradually. Year after year, the numbers change. And one day, the owner checks the balance sheet. What looked like a simple rental house became a large asset, not because of luck, because the structure of the system was designed for compounding. This is why many investors focus intensely on the first property. The first deal proves the mechanism works. After that, the process becomes repeatable. But there is an important condition. The property must produce positive cash flow. Cash flow creates stability. If markets decline temporarily, the investor can still hold the property. Rent keeps covering the mortgage. Patience becomes possible. And patience is where long-term wealth appears. Real estate rewards discipline more than excitement. The properties that create the largest fortunes are often the least dramatic. They simply continue operating for decades. Now imagine 20 years instead of 10. The mortgage balance becomes very small. Eventually, the loan disappears completely. The tenant is still paying rent, but the bank is no longer involved. Now the income belongs almost entirely to the owner. And the property itself may be worth far more than the purchase price. This is the moment the wealth machine becomes obvious. But by then the system has been running quietly for decades. And the entire transformation started with a single decision. Buying the first rental property. If this idea changed how you see wealth building, take a moment to subscribe. Because once you understand financial systems like this, you start noticing opportunities everywhere. And the next insight might change how you build your future. Script to the hidden math that makes rental properties create millionaires. Most people think rent equals income. A tenant pays monthly rent. The owner collects the check. That seems simple. But the simple view hides something important. Rent is only the visible layer. Underneath the surface, a deeper financial structure is operating. And once you understand it, real estate starts looking very different. Because a rental property is not just an asset. It behaves more like a machine. A machine designed to produce wealth through several mechanisms simultaneously. The interesting part is this. Each mechanism alone might look ordinary. But when they operate together, the effect becomes powerful. Investors often call this the four-pillar wealth engine. Cash flow, appreciation, loan amortization, tax efficiency. Four drivers moving at the same time. And the interaction between them creates compounding. Let us begin with the most visible pillar. Cash flow. A rental property generates income from tenants. That income must cover expenses first. Mortgage payments, insurance, taxes, maintenance. If rent exceeds those expenses, the property produces positive cash flow. Even a small surplus matters. Imagine a property producing $250 monthly. That equals $3,000 per year. Not life-changing immediately, but it is stable income produced by an asset. Now the second pillar begins working quietly. Loan amortization. Every mortgage payment reduces the loan balance slightly. In the early years, the change looks small, but over time, the debt gradually disappears. And remember something important here. The tenant is making those payments. The tenant is effectively buying the property for the owner. That idea feels strange at first, but it explains why long-term investors become wealthy. Here is a simple scenario. A property costs $400,000. The investor puts $80,000 down. The bank finances the remaining $320,000. After 15 years, the loan balance might fall near $250,000. The tenant paid most of that reduction. Now look at the third pillar. Appreciation. Real estate markets move slowly compared with stocks, but long-term trends still matter. If property values grow 3% annually, the numbers change dramatically. $400,000 becomes about $530,000 after 10 years. The market created $130,000 of additional value. Now combine the second and third pillars together. The loan balance decreased. The property value increased. Equity expanded from both directions. This expanding gap becomes net worth. And we still have the fourth pillar. Taxes. Real estate investors often use depreciation deductions. Depreciation reduces taxable income on paper. Sometimes the property produces positive cash flow yet shows accounting losses. That reduces tax obligations. The result is more capital remaining in the investor's hands. Now something interesting happens when all four pillars operate together. The growth becomes asymmetrical. The debt decreases linearly. The property value compounds gradually. Equity spreads faster each year. This creates what many investors call asymmetric equity expansion. And the effect becomes visible over time. Imagine two people starting with equal savings. Each person has $80,000. Person one leaves the money in a savings account. Person 2 buys a rental property worth $400,000. 10 years pass. The savings account grows modestly. Perhaps it becomes $100,000. Meanwhile, the rental property investor experiences 4 different changes. The property value rises. The mortgage balance shrinks. Cash flow accumulates. Tax advantages preserve capital. Suddenly, the difference becomes large. The property might be worth $530,000. The loan balance might be around $280,000. Equity equals $250,000. The initial investment was $80,000. This moment often surprises new investors because the wealth increase did not come from income alone. It came from structure, a financial architecture designed around leverage and time. This is why experienced investors think differently about assets. They ask a simple question: how many wealth engines does this investment contain? Stocks usually contain one main engine: price appreciation. Some stocks add dividends. Real estate combines multiple drivers simultaneously. Income, debt reduction, market growth, tax efficiency. This combination explains why property often appears inside long-term wealth stories. But there is another layer many beginners overlook: risk management. Cash flow plays a critical role here. Cash flow acts like a safety buffer. If property prices temporarily decline, the investor can still hold the asset. The rent continues covering expenses. There's no pressure to sell. And time is the most powerful ally in real estate investing. Because appreciation and amortization both require patience. The wealth appears gradually. Then suddenly it becomes obvious. Many investors notice the transformation after 10 or 15 years. They review their portfolio. The mortgages look smaller. The properties look more valuable. The income looks stable. And the realization becomes clear. The machine worked exactly as designed. Understanding this mechanism changes how people approach investing. Instead of chasing quick profits, they begin building systems. Systems that quietly operate for decades. If this deeper architecture helped clarify how real estate builds wealth, consider subscribing. Because once you understand the structure behind assets, you start seeing financial decisions differently. And the next insight might reshape how you invest for the future. Script 3: How ordinary people use bank money to build million-dollar real estate portfolios. Most people assume investing requires large savings. That belief stops many investors immediately because saving hundreds of thousands of dollars feels impossible. But real estate operates differently from most investments. It uses leverage. Leverage simply means using borrowed money to control larger assets. And in real estate, banks willingly provide most of the capital. This changes the entire equation. Instead of buying a property with full cash, an investor makes a down payment. The bank finances the rest. Imagine a property priced at $500,000. A traditional loan might require 20% down. That equals $100,000. The bank provides the remaining $400,000. Now the investor controls a $500,000 asset. But only $100,000 came from personal funds. This is where many beginners pause. Because leverage feels risky at first. Debt has a negative reputation. Yet in real estate, debt often behaves differently. The reason is simple. Tenants pay the mortgage. Each month rent arrives. That rent covers expenses and loan payments. The property becomes a self-operating financial system. Let us explore a realistic scenario. An investor purchases a duplex for $500,000. They rent both units. Each tenant pays $1,600 monthly. Total rent equals $3,200. Mortgage taxes, insurance, and maintenance cost $2,800 monthly. The property produces $400 positive cash flow. $400 might not seem dramatic. But remember something important. The investor is not the only one paying for the asset. The tenants are paying most of the mortgage. Every month the loan balance declines slightly. Meanwhile, the property value may rise gradually. Now imagine property values grow 3% annually. $500,000 becomes about $670,000 after 10 years. The loan balance may decline to around $350,000. Now pause and observe the result. Property value $670,000. Loan balance $350,000. Equity equals $320,000. The original investment was $100,000. That is a significant increase in net worth. But something else happened during those 10 years. The property produced cash flow. $400 monthly equals $4,800 yearly. 10 years produces $48,000. Now the investor has both income and equity growth. This is why leverage becomes powerful in real estate. It allows small capital to control larger assets. And those assets compound over time. Now an interesting possibility appears. After several years, the property may have significant equity. Banks sometimes allow refinancing based on new value. Part of that equity can be extracted. That capital becomes a down payment for another property. Now two properties are operating simultaneously, each producing cash flow, each reducing debt, each appreciating gradually. This is called leveraged scaling. The portfolio expands without requiring massive new savings. Instead, the existing assets help finance future acquisitions. Many experienced investors repeat this process carefully. One property becomes two. Two become four. Each asset runs its own financial engine. Income, appreciation, loan amortization, tax advantages. Over decades, these systems accumulate large equity positions. And the surprising part is how ordinary the beginning often looks. A small duplex, a modest rental house. Nothing about the first purchase feels like the start of a financial empire. Yet the structure of the system allows growth. But discipline matters greatly. Successful investors follow strict rules when buying properties. The property must generate positive cash flow. The location must support long-term demand. Major structural risks must be inspected carefully. If these conditions are respected, the system remains stable. Cash flow provides resilience during market downturns. Even if property prices fluctuate temporarily, the rent keeps paying expenses. The investor can hold the property patiently. And patience is where leverage truly shines. Because every year the loan shrinks. Every year the equity grows. Every year the system moves closer to full ownership. Eventually, some properties become completely debt-free. At that moment, the rent becomes almost pure income. The bank is no longer part of the equation. The property continues producing cash flow for decades. And when multiple properties reach that stage, the income can become substantial. This explains why many long-term investors view real estate differently. They do not see houses. They see financial machines. Machines fueled by leverage, time, and tenant payments. Understanding this mechanism changes the question people ask. Instead of asking how much money is needed, they ask how to structure the first deal correctly. Because once the first property works, the model becomes repeatable. If this explanation helped you understand how leverage builds real estate wealth, consider subscribing. Because the next videos will explore how investors analyze properties and identify deals that keep this wealth engine running.